My name's Ethan Braid, and today we're going to talk about risk scores and what does that mean for your portfolio. Over my career, I've met with hundreds of wealthy families, and one thing that's always stuck out to me is that there are a lot of people who do not understand the risk score, nor do they really know what to expect if we get into a bad market. So let me show you what can happen under different risk scores if things get bad. Here we have your standard 0 to 10 risk scale. Any financial planner that you meet with, a robo-advisor, or a bank is going to categorize your money and you as an investor in one of these different buckets that I'm about to show you here. I think that it's critical that a family understands just what can happen if things get bad before you invest your money. Investing is one of those things that you want to get it right the first time, okay? It's really important. And I think also that if you get it right the first time and you know what to expect, you're a whole lot more likely to stay invested when things get rough, like March of 2020. Or the 2000 to 2002 dot-com meltdown, or 2008 to 2009. If you had stayed invested during those periods, over time, you've done really well, okay? And we all know that long-term investing works really well. Just ask Warren Buffett. So let me show you what these different risk scores mean so that you can relate them to your portfolio. Okay. 0 to 10, everybody considers 10 to be aggressive. A 7 we would consider to be moderately aggressive. A 5 would just be moderate. A 3 is moderately conservative. And a 0, of course, is conservative. Now, what can we expect for these different classifications if we have a recession? And it's been 15 years. We're long overdue. I don't know when the next recession is coming, but it probably isn't too far away. So if we're a 0, we expect to lose 0, even in the worst case environment. If you're a 3, then under a really bad situation, we would expect to lose 14%, okay? And by the way, a 3 is going to be associated with about a 30% investment in the stock market, okay? When you look at these numbers, a good approximation for how much your money would be in the stock market is equal to the number. 3 is 30%, 5 is 50, 10 is 100%, so on and so forth. So here we are with moderate. If things get really bad, we would expect to lose 17%. Moderately aggressive, minus 20%. Aggressive, minus 30%. What I'm doing here is I'm going 2 standard deviations below a mean expected return. And this works about 95% of the time. When it comes to the stock market itself, and I want to show you the validity of this approach, is if we look at the stock market, here there's only been 5 times in the last century that we've gone beyond minus 30, or on the high end, 2 standard deviations up. And I'm going to show you. On the downside, here are the numbers. 3 times in the last century, minus 35 and 37, minus 37 and 08, minus 43 and 31, worst year on record, okay? On the upside, we've had two standard deviation plus moves, and that's been 33, 54%, 54, plus 52%. So this statistical approach works. It's been my experience in 25 years. It works really well, okay? So hopefully when you look at this, you can get a real quick feeling for where you fit in, okay? And it's really important, I think, like I said before, to get that lined up properly when you initially invest, or especially if it's been 10 or 15 years, maybe you ought to revisit your portfolio just to make sure, hey, you know what? I'm getting close to retirement, or I recently retired or whatever, and maybe I should realign my portfolio. That's another observation I have over many years, is that it is very common for people to have a portfolio that does not match how they feel, even though they filled out a profile with a financial planner or online themselves and answered a bunch of questions and were assigned one of these numbers. It's still very common for the person to be out of alignment, okay? So I hope this video got you thinking. I hope this video helps you to better analyze your financial situation and improve your family's financial plan.